Hello class and welcome to Chapter 8, speaking of losses and bad debts for tax purposes. So generally, losses on personal use property are not deductible. The exception, however, is casualty losses. For a loss to be deducted on trade or business or investment property, the loss must be both realized and recognized. Section 1231 of the Internal Revenue Code dictates character of loss upon sale of depreciable or real trade or business property, and this is discussed in detail later on in Chapter 13. So deducting losses, in order to deduct losses, we have to understand what the difference between realized and recognized are. So a loss equals the amount realized minus the adjusted basis. And the amount realized is the cash plus fair market value of property received plus the seller's debt assumed by the buyer. So the selling expenses in this equation, which are selling expenses that contribute to this, are deductible when paid if trade or business property, and if not trade or business property, then selling expenses reduce the proceeds of the sale when calculating the gain or loss. Seized, confiscated, or condemned property is treated as a sale or exchange. If trade or business property is seized or condemned, then the loss can be recognized. Loss is recognized in the year the property is seized. Abandoned property is considered abandoned if the taxpayer basically determines that the property is no longer has any value and must dispose of it for $0. Since the amount realized is $0, the recognized loss is equal to any adjusted basis, and the character of the loss equals ordinary since this is not a sale or exchange. The taxpayer has the burden to prove when the abandonment of the property occurred. Worthless securities allow a deduction that when basically securities such as stock become worthless during a tax year. A taxpayer has the burden to show when the worthlessness occurred. A mere decline in value is not enough to consider something to be worthless. Section 165 treats a sale of capital asset on the last day of the tax year. So a worthless security would become worthless if, for example, a business went completely bankrupt and out of business and that stock no longer could be sold, had any value, then it would be considered worthless. Worthless affiliated company stock. A U.S. corporation can treat worthlessness of affiliated corporation stock as non-capital and therefore an ordinary loss. Two criteria, however, for ordinary losses are in existence. So the taxpayer must own greater than 80% of the voting power and total value of the affiliate stock, and greater than 90% of the affiliate's gross receipts for all taxable years must be from non-passive income. If the taxpayer demolishes structures in order to build new assets, the demolition costs are not deductible per Section 280B. They are capitalized in the new asset that is built. So types of losses. We have capital losses, losses for adjusted gross income, ordinary losses, and losses from adjusted gross income. So notice losses for adjusted gross income can be both capital and ordinary, but losses from adjusted gross income are only ordinary losses. So here is another chart from the here's a flow chart from the chapter that helps us determine whether a capital loss is ordinary or whether a loss is capital or ordinary. I'll let you go ahead and look at this. You can pause it or look this chart up in your book if you want to go through it. Losses on Section 1244 stock. Losses realized on small business corporation stock are treated as ordinary up to $50,000 or $100,000 for married filing joint taxpayers per tax year. Losses over that threshold are treated as capital. Disallowance of losses, possible scenarios. So we have some scenarios here. We have at-risk limitations, passive activity limitations, Section 1031 and 1033 transactions, related party transactions, Section 351 transactions, and wash sales. And we've talked a little bit about some of these, and we'll continue to talk more about them as we go forward. Categories of income, Section 469 shows we have 3 categories. So we have active or material participation income. It's known as active income, but it requires material participation from the taxpayer. We have portfolio or investment income, and then we have passive income, when a taxpayer owns a portion of a business or all of a business, but they don't participate in that business. Material participation needs to satisfy only one of these definitions. So a taxpayer participates greater than 500 hours per year. That would be considered material. Or the taxpayer's participation constitutes almost all the participation activity. Or the taxpayer participates for greater than 100 hours and it is greater than anyone else's participation in the activity. Or the taxpayer has a total of 500 hours combined in several activities. Continuing, the taxpayer's material participated in 5 of the preceding 10 years also qualifies. Or if the taxpayer materially participated in a personal service activity for any 3 years prior. Or the taxpayer participates on a regular, continuous, and substantial basis based on the facts and circumstances of that individual business. So material participation continued. Limited partners do not meet the material participation, so generally, limited partner income is passive. The exception is if the limited partner meets the material participation rules in prior years, the income can be non-passive. Working interest in oil and gas property is considered active unless the taxpayer owns interest through a limited partnership. The taxpayer must apply rental losses against other passive income. And limited exception means the taxpayer can deduct up to $25,000 against other income if the taxpayer meets both requirements, which are active participation and owns at least 10% of the value of activity for the entire tax year. If adjusted gross income is greater than $100,000, then $25,000 must be reduced by 50% of the adjusted gross income greater than $100,000. Taxpayers subject to passive loss rules. So individuals, estates, and trusts, closely held C corporations, personal service corporations, and publicly traded partnerships are all subject to the passive loss rules. Taxpayers calculate income or loss with each activity separately. So if they're partners in multiple activities, they're all calculated separately. Passive activities, losses, and income are netted with each other, but cannot net against active or portfolio income. Any excess passive losses are carried over indefinitely. So let's go back to that. So if a taxpayer has passive losses for a tax year that cannot be deducted against any other income, they're carried over to future tax years to then be deducted against future passive income. Disposing of interest in a passive activity. So a taxpayer can compute the gain or loss upon the sale of interest in that activity. Any loss from the sale of activity must first offset, any other passive income. Any suspended loss from activity can be deducted, and no immediate deduction if the taxpayer sells investment or related property can be taken. It can only recognize a loss when sold to an unrelated party. Carryovers from a former passive activity. If a taxpayer starts to materially participate in a passive activity, then any suspended passive losses can be offset by any income even though the activity is no longer passive. Any losses with the former passive activity are deductible against business income. Generally, rental activities equal passive activities. The exception is if the taxpayer is involved in a real property trade or business. They must meet both requirements to be real property trade or business. Number one, it has to be greater than 1/2 personal services taxpayer provides are in real property trade or business where taxpayer materially participates, and the taxpayer performs greater than 750 hours in real property trade or business in which the taxpayer materially participates. So if the taxpayer meets these two criteria, the taxpayer is considered to be actively participating in these real estate activities. In other words, they're considered a real estate professional. So then all of their real estate activities can be treated as active or no longer passive income. If the taxpayer is an employee, personal services test is not met unless the taxpayer owns greater than or equal to 5% of the company. If married, one of the spouses must meet both tests. If a closely held C corporation, they must derive greater than 50% of gross receipts from real property business in which it materially participates. So the example of real property trade or businesses include development, construction, acquisition, operation, rental, conversion, management, leasing, and brokering. Casualty and theft losses. Generally, losses on personal use property are not deductible. The exception is Section 165 allows a loss if it arises from fire, storm, shipwreck, other casualty, or theft, and must have an identifiable event that is sudden, unexpected, or unusual. Acts constituting theft include larceny, extortion, embezzlement, kidnapping, robbery, and blackmail. So to measure casualty losses, we might look at a couple of different scenarios. The first, total destruction, means business use. Compare fair market, or means that something is obviously totally destroyed. And in order to look at what our loss is, we compare the fair market value before and after the casualty event. So for partial destruction, we use the lesser of the reduction in fair market value or the taxpayer's adjusted basis. If personal use asset, then losses are limited. Then loss limit rules are the same as a partial destruction. Measuring casualty losses continued. We cannot deduct the decrease in fair market value due to the destruction of someone else's property. We can't deduct costs to protect property, and we should obtain appraisal to determine fair market value. If no appraisal is available, repair costs may be used as long as work done merely restores the property to its pre-casualty condition. Insurance will reduce the amount of the loss, so if there's any insurance proceeds that offset the cost of the loss, it will reduce the loss. And if proceeds exceed the taxpayer's basis, then a gain must be recognized unless non-recognition provisions such as Section 1033 are used. Limitations on personal use property. If personal use property, the loss must be further reduced as follows. Each event must be reduced by $100, and the total of all net casualty events is reduced by 10% of AGI. There is only one $100 reduction per casualty event, not per piece of property destroyed in the same event. Timing of casualty losses. So theft. We must deduct in the year the taxpayer discovers the theft. Disasters. We may elect to recognize the disaster loss in year preceding loss year, and the president must declare that the region a disaster area in order to recognize the loss. And insurance reduces loss by any actual or reasonably anticipated reimbursement. If full recovery is expected, then obviously no deduction should be taken. Bad debts. So bad debts are losses if and only if there's a bona fide debtor-creditor relationship, the taxpayer has a basis in the debt, that has to be taken in the year of worthlessness, and business versus non-business bad debt is treated differently. So guarantees. So the creditor has a guarantee, or the creditor has a guarantee from the debtor of repayment, or the guarantor for repayment. Sorry. The taxpayer's basis in the debt. So to determine the basis in the debt, we look at the amount lent by the creditor and property or service to extent creditor previously included that amount in income. Deposits in insolvent banks, options, and deducting losses. So the personal casualty losses are subject to the 100% or /10% of AGI limitations, and loss will be ordinary in character. A for-profit loss is deducted on Schedule A subject to the 2% AGI deduction, and loss will be ordinary in character limited to $20,000. Non-business bad debt is deducted on Schedule D for adjusted gross income, and the deduction equals a short-term capital loss. Since it's a short-term capital loss, obviously it's subject to the capital loss limitations, $3,000 per year. Net operating losses under Section 172. So NOLs arise when business expenses exceed business income for the year. NOLs are not available for non-trader business income and expenses such as wages, dividends, interest, personal casualty losses, and mortgage interest. So computing net operating losses for individuals, we take taxable income, we add NOL deductions, we add capital loss deduction, we add personal exemptions, and we add non-business deductions that are more than non-business income, and this equals our individual net operating loss. Adding back capital loss deductions, separate net business and business capital gains or losses are net separately. The excess of business capital losses and capital gains and losses plus net business income first offsets net business deductions. Any excess net business capital gain then offsets net business capital loss. If both steps equal net losses, both capital loss deductions must be added back. If net business capital losses are greater than net business capital gains, losses cannot be offset by business capital gains. Or not non-business. I kept saying net business. So let's review this slide again. Separate non-business and business capital gains or losses are netted separately. So the excess of non-business capital gains are greater than the non-business, if greater than non-business capital losses, plus non-business income first offset non-business deductions. Any excess non-business capital gain then offsets net business capital loss. If both steps equal net business or equal net losses, both capital loss deductions must be added back. If non-business capital loss is greater than non-business capital gain, losses cannot be offset by business capital gain. Sorry for that. Net operating loss carry forwards and carry backs. So we must first carry back net operating loss starting with the 2 previous tax years, and then we can carry forward for 20 years starting with the next business year. So in this scenario, if the net operating loss arises in 2016, we first carry it back to 2015 and 2014, which means we would have to amend those returns and carry back those losses, and then we can carry the remainder forward for 20 years. Generally, the taxpayer may elect not to carry back, but to only carry forward if they desire. The election does not extend the 20-year carry forward limitation, so you still only have 20 years to carry it forward. So the election used to avoid having to file numerous amended state and local returns in the back years, right? So if we don't want to go back and amend a bunch of returns, we can elect not to carry back, especially if we're confident we can utilize that net operating loss in future years. If net operating losses originate from 2 different years are carried back to the same year, the older net operating loss is utilized first. So for tax planning considerations, we have to consider net operating losses, bad debts, and casualty losses and how they affect the taxpayer's tax return, what sort of losses can be deducted, etc. So casualty losses, elections must be attached to the tax return. Net operating losses, we can amend previous years and file for a quick refund. We use Form 1139. And worthless securities, if the loss term reported on, we report on Schedule D, Part 2. If they're long term, we report on Schedule D, Part 2. If they're short term, we report on Part 1. Thank you for viewing. That is the end of Chapter 8. If you have any questions, as always, please let me know.